Here is what no one tells you about buying stocks, and this is never talked about and could make or break your investing career. So make sure you stick with me to the end on this one. So first, buy companies you love and use. Okay, what do you use the most? Well, you're on YouTube right now. Who owns YouTube? Google. Do you Google every day? You probably do. Okay, who here has bought from Amazon? Who here owns Apple products? Who here uses Microsoft products? I just labeled 4 companies here that I'm willing to bet that 99% of the people watching this use at least 2 or 3 of these at any given time, and probably the majority of you use all 4. I personally use all 4. And the reason why buying companies that you love and buying companies, they're easier to understand. You can sit there and say, listen, I use these products. I understand how they're ingratiated in my life. I understand how, if I didn't have these, how much harder life would be. Of course, that makes perfect sense. If you didn't have Google, if you didn't have Amazon, Apple, or Microsoft, how different would your life be? I want you to imagine that right now. It'd be very different. So of course, buying what you love and buying what you use is a great idea. Peter Lynch always talked about this. This was a very common thing he said. I remember in the book, one of the books, he talked about a wife would go buy her kids their new school year clothing. And if the husband had just listened to the places that she went, he could have gotten great ideas. Belief number 2, buy growing companies. Guys, are these companies growing still? They're probably all growing. This is probably the slowest out of them all. Apple's probably growing the slowest. We've seen all these other companies grow and their stock prices have skyrocketed. That's the big thing. You sit there and say, when a company can grow very fast or even consistently, they can really compound. All these companies have great, what's called gross margin, GM. That means for every extra unit they sell, they can add a lot of money to that bottom line. So the more and more they grow, the faster and faster their profit's going to increase. The more their profit increases, what happens to the value of the company? It's of course going to go up. And that's what I love about these companies. One of my companies is Sprouts Farmers Market, SFM. Now remember, do not buy a company just because I or anybody else on the internet has it. I'm using this as an example. This company has 400 stores and they can grow to 1,250 or 1,500. They have a lot of growth potential. That's one of the things I love about them. It's important to buy companies that can grow consistently, especially if they can grow at high rates. That's where you can get the most value. Point number 3, buy dividend paying companies. Now guys, I don't think all these companies pay dividend. They pay dividend, and Google and Amazon do not pay dividend. Okay, is that a problem? Well, dividends are nice. You get the check in. They can't take that away. The market can't go up or down and take away that dividend check. Once that check comes in, that is your money. That's what's so exciting about a dividend. So even if the stock goes down 10%, you still got your 2% dividend. You only lost 8%. And as you retire, you can live off that dividend. It's like owning 20 businesses out that your neighbors own. And you sit there and say to them, guys, I want my dividend check. You can live off that money, never tap into your principal. It's such an exciting way to live. You get that check month in, month out. There's all these dividend warriors on Twitter. They love getting their dividends. I love getting dividends. Warren Buffett loves getting dividends. You can't lose money taking profits. This is absolutely not true. Warren Buffett and Charlie Munger always talk about their track record on stocks. And the one thing they always say is, apart from a few of our stocks, we've basically done about average. So you've heard me say in the past that a successful value investor will be right maybe 50 to 60% of the time. Okay. Now, this might be a hard thing to understand, but in value investing and all investing, it's all about compounding. We've all seen the charts showing growth, and growth goes like this. The more you hold on to a stock, the more you let it compound on itself, the better the company is, the more likely it is to compound on itself. You have to have these huge winners. You have to let them run in order to make real money in stocks. If you're always selling for a quick profit, you're not letting your winners run. You're not letting the ones really have the tailwind and really grow and really magnify your returns. This is also why mutual funds have a hard time beating the stock market. They have limitations of 5%. And I even heard Kevin O'Leary say, I never want a stock to be over 5% of my portfolio. Unfortunately, Kevin, you're probably not going to do very well in stocks unless you have the Ben Graham approach of buying cigar butts, which is always looking for value, buying and selling, or a lot of value investors do the same thing. But you as a retail investor who's going to add the value approach. You need to let your winners run. Because if every single time you sell when your stock makes 100%, what if that stock becomes 1,000% and you sold it too soon? And this is a common misconception, but it makes a lot of sense. I made profit. How can that go wrong? Well, if you have 10 stocks and 6 of them go to zero, you lost 60% of your money. Fine. But if the other 4, and that, by the way, I'm exaggerating here, but to show the point, if the other 4 all double, you're still down 20%. Your 4 that doubled became $8, call it. These ones went to zero. So your $10 original investment is now $8. Even though you had 4 that doubled, what you need to have is try to find the 2 or 3 that are going to grow to be multi-baggers, 10, 20, 30 times your money. Don't get in the way of compounding, as Charlie Munger always says. Once you've found a good company that can compound itself, sit back, relax, and enjoy the flight. So here's a recap why these 4 common beliefs can fail an investor. The first 3 of buy what you know, buy a growing company, and buy for dividends. They're individually up by themselves, make sense, but they get rid of one major component. What price are you paying for that? What price are you paying for buying what you know? What price are you paying for that growth? And what price are you paying for just focusing on dividend and not letting a company compound itself and keep its cash flow to keep growing? All 3 of these so far make sense. They're logical. Even the 4th one, if you can't lose money taking a profit, it makes sense. But you got to go one step further. And that's where investors fail 99% of the time. They don't go multiple steps. They hear a logical statement and think that's it. But you got to go one step further. And that's what value investing is all about. Not just taking it from one, if you're here, one domino, looking at multiple dominoes down the road and what does it mean in the future. I'm not asking you to overthink. What I'm asking you to do is say, what is the right price to pay for this? And in the 4th belief, what kind of investor are you? Are you the kind of investor who wants to sit back, pick great companies and let them do their thing? Or are you the kind of investor that wants to jump in and out on special deals and figure out the right time to sell and buy? For me, I used to be the second kind. I used to want to jump in and out. Then I realized, no, that's a lot of work. I'd rather find good companies, pay a little bit more for them, but let them compound on themselves. So what should you be doing as an investor? You should view every stock as buying a piece of a business. Price versus value. Price is what you pay, value is what you get. If you just buy based on those 3 things and that's it, you're going to buy basically a ton of companies at any price in the market. Because all those 3 things can be true. If it's a company you know and love, you buy it. If it's a company that's growing, you buy it. If it pays a dividend, you're buying it. But what about if the company is overvalued? Well, how do we determine that? That's the big difference between a true investor and a speculator. A true investor believes that there's a price that's too high relative to the value. A speculator just says, well, wait a second. I love and use that company. It's growing and or pays a dividend. I'll buy it. That's a speculator. There's no fundamental analysis done there. We've got to be fundamentally driven. If you're new to the channel, you've got to remember that what I'm trying to teach here is a process. And you might disagree with me specifically on different companies. That's fine. That's wonderful. But the process about determining what the price versus value is going to be very consistent amongst value investors, amongst any true investor. What they're going to sit there and say is, what price am I getting and what value am I getting? Your goal should be to buy when value is greater than price by a significant amount. How significant? That's for you to determine. What's your margin of safety? This is what's most important when investing. All 3 of those statements are 100% true if brought in along with price relative to value. This is why I'm against crypto being an investment. There's no value there. It's just, well, it's got limited supply. So what? With these companies, there's limited supply of Microsoft. How many Microsofts are there in the world? There's 1. Now you might sit there and say, well, Google has Google Drive. Okay, there's 2. Then what? There's only 2 of them. Does that mean both of them should be worth an infinite amount of money? Of course not. And they're both great companies, but it doesn't mean you buy them at whatever price. And you might sit there and say, well, it's not whatever price. I've heard that 1,000 times. When Tesla was at $50 versus $400, the people at 50 would have said, $250 is too much for it. But when it went to $250, oh yeah, but things have changed. But what's happened with Tesla? Tesla's gone from $415 now at $170, and yet the business is better than what it was at $415. How can that be? Price relative to value. This is the big difference. And this is what makes investors truly investors versus speculators. They know that if a business is getting better and you're able to buy it for a good price, as the stock price falls, you buy more of it. The example I always give is Microsoft. In early 2011, 2012, I met with a tech CEO, and I was making a joke about how, oh, well, of course, Microsoft has a bad rep, but you'd buy Microsoft for $1 if it had no debt and $50 billion in the bank. No, I wouldn't. I'm like, wait, no. I'm saying that you take it. No, I wouldn't do it. He insisted. It's a dying company. I'm like, but its revenue and profit go up every year. He said, no, it doesn't. I'm like, whoa, we're arguing objective truth. Revenue and profit were going up every single year, but the perception was negative. That's the difference between price and value. The price was driven down because morons like him were driving the price down because they thought something different. What I want you to do is be able to pull up the fundamentals on Microsoft. And that's what we do here. We sit there and pull up Microsoft and say, okay, how's the company doing? Well, let's look at our 8 pillars here. A lot of checks here. They're buying back shares. They have a high return on invested capital. Their cash flow is up over the last 5 years. Their net income's up over the last 5 years. Their revenue is up over the last 5 years, and they have low debt. Great. But that's why these 2 metrics, even if all these are checks, is about looking at these metrics. And by the way, just because the metrics are X's doesn't mean they're bad. If I knew Microsoft was going to double its profit every year for the next 10 years, I would buy every single share I could today, even at a high multiple. That's the difference between investing and speculation. It's about understanding that every investment is the present value of all future cash flow. And the more that you pay today, the less return you're going to make. On those 3 statements, if you didn't factor in any sort of value or fundamentals that we talk about here, anything, then the only way you're going to make your money is by the stock price going up. So the stock goes down and you don't understand fundamentally that the company is still the same or better, then you're going to make the wrong decision. You're going to make the emotional decision when you see the stock fall. Back in 2000, if you come here and look at the company, Microsoft, back in 2000, it looks like a blip here. You look at this going, what? Come on. This was $50 a share, maybe a little bit higher. And right around here was $12 or $13 a share. This is when I had the conversation with that CEO, because what he was paying attention to was 12 years of the stock price going down almost 80%. And then look what happened. Now your idiot friend here owned the stock and sold it at 60. Why? Because I thought it was overvalued. I missed the fact of point number 2. Buy a growing company, allow it to compound. I wasn't smart enough back then to realize that value. That's why I'm teaching that here today. That's why I teach that to everybody in our community. Because in our community, the focus is to buy great companies at good prices. And if the stocks fall, we reevaluate our thesis as long as the thesis is the same. And we keep out the noise of the markets and the news, because news follows the stock price. $50 a share, nothing can beat Microsoft. I remember my sister saying back here, the only company in the world that's good to invest in is Microsoft. I had a tech CEO at $12 a share, $13 a share, saying this is a terrible company. That's the difference. News follow the stock price. Even though revenue was up significantly, 7 to 8% per year, and profit was up 10 to 11% per year since 2000. Guys, this is that chart from Microsoft going back to 1998, September 1998 to December 31st, 2015. Look, it had not hit its high yet. 17 years later, it had not done that. Look at this fall from grace. Look at that. Absolutely incredible. That's the power of the news. That's the power of our perception. That's the power of our emotion. That a company can grow consistently for that time period and still fall and still be flat and get zero return for its investors. Of course, you'd be frustrated if you're the kind of person who only bought based on price. And you might sit there and say, well, I don't buy based on price. But if your buying decisions, if my buying decisions like they were 25 years ago were just based on a story, then when the stock went down, I'd be upset because the story is going to change. The reality might not change, but the perception of that reality would change. And that's all you need. The emotional part of investing is the hardest part. But the people in our community understand that. And that's why we work on it. Because we realize that the more and more we get a handle on our emotions, the more we couple fundamentals with emotions, the better we're going to do. Because everybody has the brain power, as Peter Lynch says, to buy stocks. But who has the stomach to do it? That's what the key to long-term investing is. Because anytime you buy stock, there are going to be massive fluctuations. Can you buy when those fluctuations are down? And can you hold back when the fluctuations are too high relative to the value? So if you like that idea, click the link below, join our community. We have great trial options. Go check it out. I guarantee it'll change the way in which you invest. But remember, the thing I love about these 3 points is buy the companies you love and understand once their price is relative to value. Look at the companies you love and understand and use every day as a place to get great ideas. That's what Peter Lynch was getting at. So this is why it's super important to be able to find great companies, a portfolio of companies that fit the criteria where value is over price. In our software, we have Retirement Calculator. This is a great tool. This tool, I personally am the #1 user of it on our website. I've used it several hundred times since January 1st of this year. That's how much I love this thing. This basically says, do you have enough for retirement, making certain assumptions? The assumptions I made are 35 years of age, you're going to retire at 65, you currently have $200,000 in savings, annual savings of $15,000, you're going to increase that by 5% per year. So next year will be $15,750, then $16,600, etc. During your working years, you'll make 8% return. Now, the way I factor this is the normal return on the market of 9 or 10%, less asset management fees, etc. This is what hiring a financial planner will do for you. You're probably not going to even match the market. And during retirement, you get 6%. You're going to live to 90, and you have 3.5% inflation. And your current income before tax is $100,000 a year, and you want to have about 80% of that in retirement. Because usually in retirement, you actually spend less money. Do you have enough for retirement? The answer is yes. At the age of 65, you'll have $5.3 million, which is equivalent to 1.9 in today's dollars. You have plenty to retire with. And then our retirement calculator goes one step further and says, what do you have upon death? Guys, you actually have $5 million at death. But again, based on inflation, it's $750 for today. Now, let's say you're able to really harness everything I've talked about in this video and you own it. And you're just able to beat the market by 2% per year. That's not a huge number. Warren Buffett, Ben Graham, they talked about the goal should be 2.5%, 3% a year. Obviously, Warren Buffett's crushed that, but he uses a little leverage along the way. But either way, if you're able to beat by 1 or 2% a year, let's say you get 11.5% return on your money. And then during retirement, your returns go to 9%. Because if you're a great investor, you can still invest while you're retired. Let's hit the generate button. Remember, at retirement here, we had 5.3 million, and at death, we had 4.9, so call it $5 million. What do we have with just these modifications? At 65, you now have $11.5 million, 11.5 versus 5.5, and upon death, $73 million, equivalent to $11 million today. That's the difference in how that kind of mentality, coupled with handling your stomach and handling emotions, can lead to major differences in retirement. Now, let's say you say, Paul, I don't think I can do that, but I can do a combination. Wonderful. Low-cost ETF, along with a few stocks of your own. Let's say you're just able to get 10.5% return on the money, and then during retirement, you get 8%. Instead of the $5.5 million with a financial advisor, you have 9.2. And upon death at 90, you have $40 million, equivalent to $6 million today. Imagine what you could leave to your family with that. Now, guys, if you want to apply this retirement calculator yourself, click the link below, check it out. It'll give you an opportunity for a very low cost to try out the software, not just retirement calculator, all the tools available in our community. And if you also want to watch a video on how to use that, click that next video. Take care.